Hail Mary tax planning moves to make before the end of the year: capital gains, charity, and Roth conversions. Hi, I'm Allie Jane Ayers. I write the Substack Money Changes Everything, and I've got some year-end tax planning tips for you that are a little complex, but can save you a lot of money if this is a low-income year for you. Key takeaways: capital gains brackets run off income, not portfolio size, which is why a low-income year can make large gains effectively tax-free. Appreciated stock is the smarter charitable gift because it gives the charity the full value while letting you bypass the capital gains tax entirely. Low-income years are ideal for Roth conversions, since the tax cost is minimal and the long-term benefit is significant. Did you have a shitty year? I'm sorry if you did, but cheer up, Buttercup, because it's tax planning time. We have just a few weeks left in the year to actually make a difference in the numbers that get reported on your tax return. Folks often come to me in January looking for help to reduce their tax bill, and I'm so sorry to say that it's often too late. The way to impact the taxes you owe is to make moves during the calendar year of the tax year you will be filing for. In other words, before December 31st. But even this late in the game, if you're only starting to think about your taxes now, in my view, these are the best ways to change your tax outcome with about a month left in the year. Number 1, harvest capital gains or losses. Number 2, donate to charity. Appreciated stock is best. Number 3, Roth conversions. Let's talk about capital gains and losses. I always joke with my business partners that we should host a capital gains matching party for our single clients. One client might have a huge taxable gain this year while the other started a company and has no income. If they get married, their collective tax rate will likely be significantly lower. There are only 2 ways to make money. You can work for it, or you can let your money do the work. When you work, you pay some of the highest tax rates in the system. When your money works, you pay less. That's the not-so-secret reason everyone is so obsessed with capital gains. If you sell something you own for more than you paid, the profit is a capital gain. Simple enough, but the government can't make anything simple. So there are brackets, exemptions, and timing rules that make you want to gouge your eyes out. For example, there are 2 kinds of gains. Short-term gains are when you hold an asset for 1 year or less. This is taxed as ordinary income. In other words, congratulations, you have recreated the privilege of earning a paycheck. The highest short-term rate gains can be taxed at is 37% at the federal level. Long-term gains are held for more than 1 year. They get taxed at special rates that supposedly encourage investment, but mostly just encourage wealthy people to avoid selling anything. The highest long-term gains rates can be taxed is at about 24% at the federal level. So you see, living off investments you sell instead of working for a salary saves you about 13% in federal tax at the highest level. For 2025, the long-term capital gains brackets are 0% for up to $94,000 if married filing jointly, or $47,000 if filing single. 15% rate up to $583,000 if married, or $518,000 if you're single. 20% on everything else above that. And you'll need to add this special 3.8% surtax if your income is over $250,000 if you're married, or $200,000 if you're single. Here's the part that people misunderstand. These brackets apply to your taxable income, not the size of your portfolio, and not the amount of gain floating around on paper. What you actually sell in your investment portfolio is what lands in these brackets on top of your paycheck or freelance income. This is why a high income year pushes your gains into higher brackets, and a low income year can make gains practically tax-free. How you can have a $1 million portfolio with huge gains and pay 0 tax when you sell. Imagine you have a $1 million portfolio. Sounds great, right? Maybe you put in $300,000 over the years and the other $700,000 is pure gain. Those gains are only on paper until you sell. Now imagine you have $0 of income this year. No wages, no consulting, no side gig, nothing on the tax return. This is exactly the kind of year that wealthy families quietly love because it gives them access to the 0% capital gains bracket. Here's how the math works, as I said above. Since your income is $0, the entire 0% bracket is sitting there unused. You can fill every dollar of it with long-term capital gains. So if you're married, you can sell about $94,000 of gains and pay absolutely nothing in federal tax. Nothing. You could trim almost $100,000 off that $1 million portfolio and pay no tax. If you're single, you can harvest about $47,000 of tax-free gains. And remember, you are selling gains, not the portfolio value. So if you sell $150,000 of stock and 100,000 of that is gain, you're only paying tax on that 100,000. That's the part that counts towards that bracket. This is why wealthy people orchestrate their income. They keep ordinary income low, or they stagger it across years, and they use the entire 1% bracket to harvest gains without paying tax. Once you understand this, the rest of the strategy suddenly clicks into place. Let's look at a case study. The modest investor. You and your spouse earn $70,000 in wages. You sell stock you inherited for a $40,000 long-term gain. Your wages already chew up most of that 0% bracket, but about $24,000 of your gains squeeze into the leftover 0% space. The other $15,950 gets taxed at 15%. So you'll pay about $2,392 in tax on a $40,000 profit. Your effective tax rate is just under 6%. That's not a tax bill. That's a tip to the IRS for paving your street. Harvesting losses. Harvesting losses is a simpler sibling to gains. If you sell an investment for less than you paid, the loss can offset your gains. If your losses exceed your gains, up to $3,000 can be used to offset ordinary income. That means your paycheck. The rest carries forward indefinitely. That's right. You could sell a ton of stock at a loss this year and then carry that magic gain canceling credit forward into the future. Are you starting to see why it might be a good idea to have a financial advisor when the numbers get big? In short, losses cancel out gains automatically. Excess losses offset up to $3,000 of regular income in a single tax year. Anything beyond that rolls into future years like a golden ticket. Loss harvesting is not about being clever. It's not about wasting a loss you already took. If you lost money anyway, you might as well let it reduce your tax bill. Charity. Then there's charity. Cash donations are deductible if you itemize your tax return. The most common situation for itemizing is if you have a mortgage. Since the mortgage interest is deductible, your accountant will probably decide if you're better off itemizing your return instead of taking the standard deduction that everyone gets. The standard deduction for 2025 is $31,500 for a married couple. So when tax time rolls around, my accountant will look at the forms from my bank to see if I have paid more than $31,500 in mortgage interest. If yes, I'll probably itemize, which means that my charitable donations will be counted. There will be new rules for charity for 2026, thanks to the One Big Beautiful Bill Act, but we in the tax community are still sorting through them. So if you're going to itemize your tax return, donate to charity, or carry out your charitable giving plan this year, it's a fantastic way to give to causes you care about and pay less tax. A dollar donated to a qualified charity, remember, political contributions are not tax deductible, is a dollar that is subtracted from your taxable income. The rules are a little complex, but that's the gist. But the real magic is donating appreciated stock. When you hand over shares of an appreciated stock directly to a charity, you get a deduction for the fair market value, which is typically the current stock price on the day that you give it over, and you skip the capital gains tax entirely. More on this below. The charity sells the stock on their end and pays no tax because they're a charity, they're exempt. You save money, they get more, and neither of you sends a penny of that gain to the IRS. A real example of how donating appreciated stock saves you money. Ingrid works at Google. She is generous, but a little overwhelmed by tax planning. She wants to donate $5,000 to City Harvest because she has seen her New York grocery bills and understands that food security is not abstract. She can afford it on her Google salary, but knows many are struggling. Her first instinct is to write a $5,000 check. She would get a $5,000 charitable deduction if she itemizes, which is fine, but not optimal. She has a mortgage on a condo, so she will likely itemize. What Ingrid forgets is that she also has RSUs, restricted stock units, which are a form of compensation, from Google that vested in 2021 when the stock traded at around $100. Today, the stock trades at around $320. Every one of those shares carries a $220 built-in gain. If she sells the shares and then donates the cash, she will still owe capital gains on that $220 per share. At a combined 20% or so, she is giving the IRS about $44 in tax for every share she sells. Ooh, say that 5 times fast. Still, she gets the deduction for whatever she gives to charity, but she took a completely unnecessary tax hit on the sale. There is a better way. Let's say she donates 16 shares of Google at today's price of $320. That's a $5,120 charitable donation. She gets a deduction for the full fair market value, and she avoids paying capital gains tax on roughly $3,520 of embedded gain inside those shares. She gives more to charity. She pays less to the IRS. City Harvest ends up with more money than if she had written a check. This is the rare moment where everyone wins except the government, and the government is the one that wrote the rules to make this possible. Donating appreciated stock is simply the smarter version of generosity. It takes the money you were going to give away anyway and lets you skip the tax bill on the way out the door. Most larger charities will have specific instructions on their website for how to donate stock. The process is a little more involved and takes a few weeks, but it's totally worth it. Roth conversions. Typically, we recommend Roth conversions to retirees or older folks with little or no income. But at my firm, we do them fairly often when a client has a random year of low or no income. It happens. If you truly had a lousy year, you may have one of the only silver linings available in financial planning, which is the chance to do a Roth conversion at a very low tax rate. In a bad income year, you can convert pre-tax retirement money into a Roth IRA, pay little or nothing in tax now, and secure zero tax on the growth later. A Roth conversion is simply moving money from a traditional IRA to a Roth IRA. The amount you convert shows up as income this year, and if your income is unusually low, that tax hit can be tiny. After that, the Roth grows tax-free and comes out tax-free. It's the rare moment when a shit year gives you a genuine advantage. Make haste. December is the last month where any of this advice still matters. Once the calendar year switches over to the next year, whatever you earned, lost, sold, or forgot to deal with is locked in for your tax bill. That's why these final weeks are worth your attention. Pull yourself out of bed and get to work. Capital gains harvesting, charitable strategy, and Roth conversions are some of the only tools that still move the needle this late in the game. A low income year can be used to clear out gains at a 0% rate. Appreciated stock can leave your account and land with a charity without dragging a tax bill behind it. And a Roth conversion can turn a bad year into something useful, even if only on paper. Most people wait until it's too late. You do not have to join them. And here's my parting shot. Make tax moves while you still can. In the world of tax planning, laziness is very expensive.